Hey Steve, so the budget was yesterday. Rachel Reeves announced a variety of new measures to come in, and I think one of the things we want to get through today is how it affects the people on the street and business owners.
Yeah.
So to kick things off, one of the things that came out was dividends. From April 2026, they're going to rise by 2% for the basic rate and higher rate dividends. I guess my point to ask you is, how does this affect business owners' remuneration strategy, and in general, what are your thoughts?
Yeah, so I guess dividend tax 2%, like you say, on basic and higher rate. The additional rate didn't get touched, so that was one slight comfort from it. I think the overarching feeling with this is from the government's point of view, is the tax and dividends because it's not a tax on working people,
Yeah.
which obviously we know is not the case. We've got a lot of clients that will remunerate through dividends, so it's definitely going to have a bit of an impact. We've started running some numbers on remuneration strategies, so if you take a combination of salary and dividends, how that's going to impact you, and it's basically nearing the gap from a dividend strategy to a salary strategy.
Yeah.
So we need to, I think it's going to be individual person by person, that's the tough one on it. The conversation probably is going to get to, we need to have a conversation with every client, have a chat through it client by client and see where we'll get to on it, because it is definitely going to be individual to each person.
Yeah, absolutely. It's not as clear cut as it used to be back in the
Definitely
day.
not.
So, another key point that's also come out that's going to affect business owners and people on the street is the income tax rate on interest and savings. This will increase by 2 points from April 2027. How will it affect normal working people?
Yeah, so again, this one, the government's view is that it's not working people who have savings or property income, which again is a very interesting view. I guess the thing that with this is that savings income and property income both don't attract national insurance. So that's kind of the view that they'll increase this slightly. So from a tax point of view, it obviously makes things more complicated. So you've now got two different tax rates for kind of income from salary or other sources, and then the savings and property income. Nothing else has really changed. So basically you're paying 2% extra on those income sources. Savings in income you can't really do anything about. I think the big thing that a lot of people were talking about beforehand, if property income was a tax, was that potentially is just going to get passed on to people who are renting. So I guess that's the big risk with this, is that rental income, people who have rental income are going to pass that 2% on to people who are renting from them. So then rent becomes more expensive. So that's the big risk there. So again, I think people are just going to have to look at rental income and tax that is due on it, and do a bit of modelling going forward on how that's going to be impacted.
One that's kind of caught a lot of people's attention is the taxation on properties valued over £2 million. There'll be a new annual tax. It's not starting soon, it's in 2028, but how do you feel people will react to it?
I mean, it's obviously a bit of a controversial subject, I guess. £2 million properties, I wouldn't imagine we've got a huge number of people who are going to be impacted this, definitely in the northeast. More so for kind of London-based clients. I'd like to say it's relatively immaterial in size. It's kind of £2,500 for a £2 million property, and I think it jumps up to £7,500 if the property's worth over £5 million. I guess controversially, if you're in an income position where you can go and buy that value of property, then you're probably quite fortunate. It's probably not going to hurt too much. I'd feel relatively all right about it. The side of it that probably is going to hurt a little bit more is if you've potentially inherited the property, or if you're a widow. Then there's going to be a bit of a bigger impact. So that's probably where I'd look at that side.
Well, you never know. Might affect the housing market in a few years' time, might not, based on the value of the actual tax. So we'll see. A more interesting, quirky one that probably a lot of accountants will actually be asked is the salary sacrifice changes, particularly over pension contributions above £2,000 a year, will no longer be exempt from national insurance. It's not happening soon, it's from April 2029, but a lot of people are probably asking, saying, how does that affect what I do with my salary sacrifice in regards to pension?
Yeah, again, this was kind of talked about quite a bit leading into it, and salary sacrifice was mentioned quite a lot, that it was going to get a tax going into the budget. So I think they've kind of gone relatively low touch on this, just going after pensions currently. Like you mentioned, we've got a few years, so who knows what happens in future budgets. I think the view on this was that a lot of people who earn big bonuses in the city contribute a lot of that to pension, get a lot of benefit from it. So the government kind of wanted to look at that and go after that. In real terms, a lot of working people use salary sacrifice. I also think a lot of public sector things like the NHS use salary sacrifice, so this is going to impact a lot of people. Again, it's going to just be a case by case of going through and kind of looking at it for everyone's salary, what kind of contributions are being made, and then looking at it. But yeah, the bottom line is there's going to be an additional cost for people who have salary sacrifice schemes in place, and whether that's footed by the employee by way of not getting a pay rise going forward or something like that, and that's how the business offsets it, or whether the business swallows the cost. I think overall it's going to have to be taken somewhere, and the business is going to have to decide how to do that.
Absolutely. But like you said, Steve, it's not something that's going to impact business owners and people on salary sacrifice imminently anyway, due to time.
To do some planning for it.
Another interesting one was cash ISAs. It was at 20,000 band. It's been reduced to 12,000 for the cash element of it. But there's a few rules over if you're over 65 and still topping up to be stocks and shares ISA. What did you make of it then, Steve?
So a lot of this was around trying to increase the contributions or the investment into UK companies. I think that's where they're trying to kind of get to on this. Like you mentioned there, Josh, it's kind of over 65s can still contribute. So it's under 65, so you're reduced to 12k. There was some stats out a little while ago about how many people maximise the full 20k allowance into ISAs. I can't remember exactly what the numbers were. It might be 1 million people across the UK. So it's a fair number, but it's not kind of huge. Cash ISAs have been widely kind of
used,
publicised and used. It's a good tax-free mechanism of saving some cash, and obviously you're putting 20k a year in, the compounded interest everyone knows about. It's great. So it is a fairly decent kind of tax strategy people have been using. They obviously haven't taken it out. You've still got 12k, so I imagine a lot of people will use that. And then, like you said, you can use the additional 8k to put into stocks and shares ISA, which people might be doing anyway. I guess what I'm looking at is the 8k now could go into that additional 22% savings income or 42% savings income. So yeah, they've kind of taken a little bit, but I think what a lot of people will do will just switch it to a stocks and shares ISA instead or something like that. So yeah, I guess it's to watch the space while on that one.
Let's see how the market reacts. Another interesting one, the word fiscal drag came up a lot when talking about the budget. Personal tax thresholds frozen until April 2031, so after actually the current government. A lot of people saying, again, what does this mean? Are they going to slowly end up paying more tax than they normally would?
Yeah, I think that's the message, isn't it? The government's kind of not selling it as paying more tax, but yeah, it's obviously going to drag more people in. I think the next thing we're probably going to talk about is the minimum wage increases. So this naturally pushes more people into higher income bands. Most people will earn more year on year if it's minimum wage going up or whether it's just inflationary pay increases. So naturally, if the thresholds haven't moved, then more people are going to pay more tax. I think this is a relatively good earner for the government, and they kind of get a fair amount of tax from it, and a lot of people are referring to this as the stealth tax.
Yeah, absolutely. Income tax is by far the biggest earner for the UK Treasury in that regard. National living wage, as you mentioned, is up again. April 2026 increases to £12.71. 18 to 20-year-olds, they're also going to be set up at £10.85 as well for the national minimum wage. So again, it's going hand in hand with people are likely to be earning more, but then also probably going to be paying a little bit more tax as they get dragged up. Is that your thoughts as well?
Yeah, essentially that. I think that obviously there's a lot of views around minimum wage. I think overall it's probably a good thing that they're increasing. Obviously it's trying to combat the cost of living crisis. The hard thing is that businesses have to then forecast that in, alongside the increase in national insurance from last year and other bits. It does become difficult if you employ a lot of kind of minimum wage workers. Things like hospitality and those kind of industries obviously take this quite hard. So yeah, again, it's one that you're gonna. I mean, it's a 8.5% increase for national minimum wage for 18 to 20-year-olds. Fairly decent increase across that kind of pay bracket. So yeah, you probably need to be looking at forecasts for next year and seeing how that's going to impact you. I imagine for some people it'll mean that they don't hire that extra person that they're going to.
Okay. Last but not least, so with the trend in electric vehicles in this country in particular picking up, as prices drop and ownership increases, the government has now kind of adapted a mileage-based tax for electric vehicles and plug-in hybrids specifically. This isn't happening imminently. It's to be introduced in 2028. It's going to be 3p for electric vehicles, 1.5p for hybrids. A lot of people say, is it still worth getting an electric car if taxes are on the rise? But what does it actually mean, Steve?
Yeah, so I think the big thing with this is that obviously, like you said, the increase in electric vehicles is huge. A lot of people have taken kind of a benefit of the fact that the benefit in kind on them is low. So they've utilised that through salary sacrifice schemes or purchasing them through the limited company. So there's been a massive uptake in electric vehicles. I think that it's a bit of a controversial on this. So you've got obviously people have utilised those schemes and the push that the government have made in previous years to drive electric vehicle uptake, and you've now got them applying this tax.
Yeah.
The government's worry is that they're losing a lot of the tax income or duty income that they get from petrol and diesel vehicles. You've also got the question that I've seen raised straight away from many kind of commentators on this, which is, if you've got a petrol or diesel car, they've kind of got the duty going through, that's fine. If you've got an EV now, how are they going to know what the mileage is of those first 3 years? Because you don't do an MOT.
No, you don't know.
Quite easy if you're pushing an MOT through that, you get your mileage from that. But if you're buying an electric car, you keep it for 3 years and then you trade it in, are they going to hit you in year 3 for 3 years worth of tax? I don't know. There's obviously, they've got a few years to work this out, but I'm not sure it's been fully thought through, if I'm honest. And then there's obviously going to be the administrative burden of they've got to process all those mileage inputs, and then they've got to work out how they're actually going to collect the tax from it. So
a lot of admin costs on the government side
potentially,
into implementing this. It's still only in 2028, so still a few years away yet. All right. I think that was our quick roundup our side. So thank you everyone for listening and watching us. Hope you got something from it. Again, if you've got any questions, please drop us a line, LinkedIn or email. Please contact us if you've got any queries.
Thank you, everyone.
Thank you.